This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, great to have Lynn back on the show. Joining us again in the Postgame segment is Nick Galarnik. Also, we will shortly be joined by Anas Alhajji for an update on the crude oil markets. Now, let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Lynn's picture saying, looking for the downloads. Now, Eric, let's get to crude oil, starting with the EIA inventory.
EIA printed a drawdown of 4.5 million barrels. That's reversing the trend of builds for the last couple of weeks. Cushing, Oklahoma, drawing down another 758,000 barrels, taking us really back down to about 20 million barrels. That's the virtual tank bottom level in Cushing, Oklahoma. Of course, 20 million barrels is not an insignificant amount of oil, but they need a certain amount of oil in order to be able to support their blending operations and so forth. They're really at a functional minimum right now. So we have a crisis situation there that's really important to keep an eye on. More importantly, the drawdowns are spreading back into finished products. Gasoline drawing down 2.4 million barrels. Distillates drawing down 3.2 million barrels. U.S. production is holding unchanged this week at 13.2 million barrels, but last week, when we weren't able to report due to the holiday, we had a really big jump up to 13.2. So we're now at a new all-time high in U.S. production. A very important question to ask is, how long can that last? We're working on getting some guests lined up in coming weeks to talk about that subject. I said last week that this is a major variant perception moment for me. I think the risk to the already vulnerable oil market from a further escalation of the Israel-Gaza conflict is extremely high. To my own surprise, though, our very well-respected colleague, Dr. Anas Alhajji, has a much more moderate view of the extent of that risk. So to balance my own admittedly strong views, I'm going to invite Anas on in just a couple of minutes to give us a quick update. But let me first start by explaining my own views on this developing systemic risk to the oil markets. First of all, MacroVoices will take no sides in this conflict between Israel and Hamas. As financial journalists, our job is to report objectively on what geopolitical developments are likely to mean to financial markets, not to opine on the merits of the events themselves. So my view begins with understanding that the global oil market is already very fragile. With the exception of Saudi Arabia and the United Arab Emirates, OPEC is already producing at capacity. Everyone is assuming that rational expectations theory is going to continue to apply. In other words, any country that's got oil and is in the business of producing oil is going to sell their oil at the highest price they possibly can because that's what's in their economic best interest. And everyone assumes that they will just continue doing that indefinitely. I think that's the dangerous assumption. The Russia-Ukraine war already poses the risk of the stakes rising to levels where I think there's a chance that Russia could take an economically irrational action, such as not selling all of the oil that it's producing, in order to prosecute a political agenda, such as cutting oil production for the intentional purpose of weaponizing oil prices. Even though that doesn't seem to be in Russia's economic interest, it may be that they put higher priority on their political agenda than their economic agenda. Now we have this Israel-Arab relations situation blowing up in a way that's not going to blow over anytime soon. Again, we're not taking any sides on who's right or wrong in this conflict. My point is simply that an escalation has occurred that cannot possibly be undone. The atrocities on both sides, the extent of just how much violence has occurred in the last few weeks cannot be undone or forgotten. So there's going to be a long-standing long-standing rise in geopolitical tensions in this area. Now, there's no significant oil production in Israel or Gaza, so there's no direct risk here. The risk is from a broader regional conflict developing to the point where some of the oil-producing nations begin to make economically irrational decisions in support of a political agenda. Now, they don't have the option of increasing their oil production in reaction to any geopolitical situation because most of them are already producing as much as they can. The question is, are there scenarios where we might be assuming they're going to continue to sell all of their oil and they don't do so? I think that's a very high risk, but Dr. Anas Alhajji, who's very, very knowledgeable on this subject, actually has a more modest view. So let's bring in Dr. Anas Alhajji now. Anas, some people are saying it's 1973 all over again, oil embargo. We're going to see tripling of oil prices. Other people say, no. Look, there's no significant oil production in Israel or Gaza. This is irrelevant to oil and gas markets. I got to believe it's somewhere in between. Which is it? And also, is it just about oil or is gas a different story than oil?
I think you summarized it very well here. We have to remember the following. There were three embargoes historically. The first one was in 1956. That was imposed by Saudi Arabia on the UK and France when they attacked Egypt after Egypt nationalized the Suez Canal. And then we have the embargo of 1967, that's during the war. And then that was several countries, not only Saudi Arabia, about seven Arab countries imposed the embargo. Both of them failed and failed miserably. And the first one was symbolic. The second one, they tried to do something, but it did not work. And then in 1973, we had an issue here because on the 17th of October, yesterday was the 50th anniversary of that, the ministers recommended an embargo. On the 18th, we had two countries that imposed the embargo. Then on the 19th, Saudi Arabia joined them, and the announcement was official of imposing an embargo that was associated with a production cut to make the embargo more effective. And the embargo was on three countries, the United States, Denmark, and the Netherlands. And what we see here is this was a total failure. And this fits with the literature. We have a literature of 120 years that covered all kinds of sanctions from all countries. We have hundreds and hundreds of events, and each one of them failed. And the embargo fits with that. It did not work. Why it did not work? Because the first thing is, what was the objective of the embargo? The objective of the embargo was to force Israel to the borders of 1967, or what they call the UN Resolution 242, and stop the Western support for Israel. That was in 1973. Now look at now. Israel expanded, and the support is stronger than ever. And we have President Biden today there. So it failed miserably because the declared objectives of the embargo were not achieved. And when we say declared, because there could be some other unknown objectives, and I'm going to allude to that in a minute, of the embargo. And if the undeclared objectives basically are correct, then those countries achieve their objective. But the two declared objectives of returning Israel to 1967 borders and to stop the Western support to Israel, both of them were not achieved. The embargo lasted for about 2 months. The actual embargo lasted for about 2 months, but the official embargo ended 4 months later. What's strange about that is this. People think that this was an OPEC embargo. It wasn't an OPEC embargo. It was several Arab countries who did this. OPEC has Arab countries, non-Arab countries, including Iran and Venezuela, Indonesia, and others. So it wasn't OPEC. Was it AWAPEC, that the Arab oil-producing countries? No, it wasn't, because there were other Arab members did not participate in the embargo. But the issue here is this, that they say that oil prices quadrupled because of the embargo. That is another mistake. They did not quadruple because of the embargo, because 2 days earlier, before the embargo, OPEC met and increased posted prices by 70%. Posted prices are the prices that are used at that time to calculate taxes, because there was no price of oil in the market at that time. No one knew what the price of oil in the market, because the companies, the oil majors, were vertically integrated. They sold within the company itself. So the producer sold to the refiner, and the refiner sold to the distributor, but all of them are the same company. So we have some sort of transfer pricing, but no one knew what the price is. So they have to come up with something to measure taxes. So they came up with the posted prices. So by increasing the prices by 70% unilaterally, they forced the companies basically, or they increased the cost of the companies significantly. And the companies, since they are integrated, they had to pass it to the consumer. So prices went up because of that. So we cannot say that the embargo increased prices by fourfold. The embargo itself was, again, based on the declared objectives, was a complete failure. However, there is, and I'm speaking academically here, studies that been done on this concluded the following. The embargo achieved its objectives. And what were the objectives? Arab nationalism at that time was very strong. Communists in the Arab world were kind of really strong, and some of them basically in power. And many people, even in the Gulf countries, were either Arab nationalists or communists. And that was a threat to the existing governments that were supporters of the United States. And the idea here is, if it wasn't for the embargo, the Soviet Union would have controlled the area, and we would not have seen the oil flow for the last 50 years coming from the Middle East to the United States and Europe. So they had the embargo literally to pull the rug from beneath the communist and Arab nationalists. So you don't see the Arabs led by Cairo or Damascus or Baghdad. Now it is led by Riyadh, Kuwait, and Abu Dhabi. So if that's the objective, it was achieved. So this is the undeclared objective in this case. But it was a total failure. Why? Because the suffering of those countries in the 80s when the market collapsed was massive. Massive to the extent that those governments almost went bankrupt. And everything in those economies just stalled, completely stalled. There was no money. Imagine that in 1985 and 86, Saudis had to cut production from 10 million barrels a day to 2. So the cut alone was more than the exports of Saudi Arabia today. The cut was 8 million barrels a day. Yet, oil prices continue to decline. Not as if this is not enough. We lost the Iraqi oil, we lost the Iranian oil. So we lost this 8 million from Saudi Arabia, and we lost about 5 million from Iraq and Iran. And yet, prices continue to decline. Why? Because high prices in the 70s after the embargo led to the building of the Alaska pipeline. That's 2.5 million barrels a day. Then the North Sea came in online, that's 3 million barrels a day. Then we found oil in more than 15 countries. They did not discover oil before. So we had more oil than ever. At the same time, look what we did in the United States. We helped establish the International Energy Agency, which is a headache for OPEC and Saudi Arabia right now. They started the SPR, the Strategic Petroleum Reserve, which is a big headache for OPEC. They established the Department of Energy, which is spending billions of dollars on renewable energy, EVs and batteries and everything else. And we had the speed limit that increased the efficiency. We had the CAFE standards that enhanced and improved the efficiency of engines and reduced gasoline consumption big time. We have all those efforts between Europe, the United States, Japan, and others that reduced the demand significantly. So we ended up with lower demand and massive increase in supply, and nothing. The efforts of Saudi Arabia and the loss of Iraqi and Iranian oil did not even help improve prices, and those countries suffered for more than a decade. So the idea here is they paid the price heavily for it. They learned from it. They know that oil cannot be used as a weapon. They have 3 experiences. It failed every time. They lost market share. It takes between 8 years to 15 years to recover market share. So the bottom line here is, do not expect the oil weapon to be used again.
Anas, I want to fast forward to today based on what you just said. You're saying it sounds like governments are not likely to invoke this oil weapon because it hasn't really worked effectively in the past. But in terms of public sentiment, a whole bunch of very strong public anger is being developed on both sides of this conflict. And in the Muslim world and the Arab world, certainly the politics it's leading to riots and so forth all over the place. If there are not likely to be governments weaponizing oil or the oil price tool the way you're saying, what about terrorist organizations and others that might be reacting to just the public sentiment that's now occurring?
I think probably if you look at oil prices and the increase that we've seen, which is about almost $7 now, what we call the political premium, is really because of that. Forget about the Iranian statements about the use of the weapon, because the Iranians been saying this for 40 years. In fact, today on my Twitter feed, I posted a statement by Mahmoud Ahmadinejad, the former president of Iran, who said something like this exactly after the Israeli army basically went to Gaza and killed a lot of people. And he said, oh, we need to impose an oil embargo. And you can see it, you can read it. It is on my Twitter feed. So these are all things. But the fear, this is real, that individuals or organizations can wreak havoc on the oil industry. Why? Because the technology improved substantially in recent years, that with like few $100s, you can literally cause problems to a major oil tanker or a major oil facility. Drone for $200-300 basically can help do that. So the improvement in technology enabled individuals and small groups to cause major damage. And this is a real possibility, because people are looking at their governments and they think that their governments are not doing enough. And therefore they are angry at their governments as much as they are angry at the Israelis. So this is a real threat.
Anas, final question. Let's talk about gas versus oil. Is it the same story, or are they different, and why are they different?
This is a completely different story. And the reason why, because Israel has 3 gas fields, and Israel exports natural gas to Egypt and Jordan. And Tamar field, you can see the Tamar field from the Gaza beaches. It's too close to Gaza. So they closed it. And closing Tamar basically means reduction of gas to Egypt, reduction of gas to Jordan, and not enough gas within Israel. And that is a problem, because the other 2 fields cannot compensate for Tamar, and therefore Egypt cannot re-export the gas in the form of LNG to Europe, so the impact is on Europe. And the Jordanians are not going to have a major energy crisis because of that, and they have to resort to LNG. As for the Israelis, and this sounds like really strange, the only way for the Israelis basically to compensate is to import more coal. And that's a problem, because the Israeli left and the Israeli climate activists are going to go crazy when their country is going to import more coal to burn in power plants. So we'll see how they are going to justify that. But the main outcome of all of this is this conflict, the final nail in the coffin of any gas pipeline from the Eastern Mediterranean to Europe. What we are seeing right now, the options for Europe to substitute Russian gas are dwindling. And the only 2 options left are the United States and Qatar. And therefore, we believe that Russian gas will continue to flow to Europe for a very long time.
Anas, I can't thank you enough for joining us for this update. Before I let you go, just tell our listeners where they can find your Twitter feed and your Substack if they want to follow your analysis in more depth.
Sure. Everything we talked about today and others, basically, we already published reports on that. And we have it on Substack. They can go to my Twitter account, Anas Alhajji, ANASALHAJJI, and they can get all the information from my bio there or my tweets. So all the information is there.
Thanks so much for joining us, Anas. We look forward to getting you back for a feature interview as our schedule permits. Let's continue with our post-game segment now.
Well, Eric, on page 2, I have a crude oil chart, and I just wanted to highlight how we are now on the December contract trading already back toward its highs. Obviously, the front month contracts back then were at higher levels, but generally, we have an oil market that is poised for a bull breakout. Now, we haven't yet broken those 90 levels, which I think are going to be critical for really building a new trend. But if we see a proper breakout here, that could really set in motion a bull continuation pattern. I'm watching the 88 and 90 levels on the short term, just as levels where I think a continuation pattern can really emerge. Now, Nick, I want to get you in the conversation. Let's talk some of these equity levels. I want to give my observation on the S&P in a moment, but I want to start off with just what are the technical levels in the option market implied suggesting here on the S&P?
So Patrick, spot price right now is 43.15 on SPX. We have a call wall above at 4,400 and a put wall below at 4,300. The implied move for the November 17th monthly OPEX is plus minus 165 points. So the upper potential move would be 44.80 and the lower potential move would be 41.50. The key resistance area right now is above at 4,400 and just below at 4,300 and 42.50 are the key support areas. Again, as I mentioned last week, I'm inclined to think we see a big move out of this range after the VIX expiration yesterday. I think we either break to the upside perhaps a little bit to 44.50 perhaps, but I'm more inclined to think that we test out that 4,200 level prior to perhaps some stability before maybe making a bounce back to this area again. But we've been bouncing in this range between 4,300 and 4,400 for the past couple of weeks, and I think that's going to conclude in the next couple of days.
Well, it's interesting you say that. Like, obviously, we had the big OPEX week, which causes gamma pinning in trade ranges with huge put and call walls between 4,400 and 4,300 on the S&P, like you were suggesting, and that certainly has pinned the market. We have the big gamma roll-off coming on Friday as the index options all roll off. So I think volatility returning into next week is very likely. Sure, a quick little pop up to 44.50 is certainly something within reason in terms of just markets whipping higher and lower. But I just, when I look at the broader intermarkets and the way yields are breaking and the way a lot of other markets are behaving, the way the breadth of the market continues to deteriorate, it to me looks rather bearish. And the 4,300 level, I think, is actually very important because when the way I look at it is any price action that starts breaking below 4,300 is marking some sort of a distribution cycle that would line up with a Russell 2000 that is breaking to a fresh low, that would start to see deterioration in other markets, including the NASDAQ giving out 15,000. All of these things can really start to come together and open the floodgate for another leg down. And I know the implied range was down to 41.50 that you were saying, but I think we could make it down to even 4,100 with some accelerated selling next week. The big thing for me is watching the 4,300 pivot and whether it gives out. Now let's move on to the NASDAQ. What are the levels you're watching here?
Spot price on the Qs right now is approximately 363. We have a call wall above at 380 and a put wall below at 345. The implied move for the November 17th OPEX is plus minus 19 points. So the upper potential move would be 382 and the lower potential move would be 344 approximately. We have key resistance above at 370 and 375 and key support below at 360 and 355. Given that we're entering earnings season right now, a lot of these moves will be dictated by what happens with earning reports. We had Netflix beat last night, Tesla missed handedly, and they're respectively right now. Netflix is up a lot, and Tesla's down about 7% or so. So right now, we need to wait for the next couple of weeks to see what happens. But if earnings are poor from the big guys like Apple, Google, Meta, Amazon, Microsoft, that will bode for a lower move, obviously. And if they're strong, it may move higher, right? But in the short term, I do think that we may top out somewhere around 370, 375, and then make a lower low around 335, 340 or so.
You know what? I completely agree with almost everything you said. The first observations to make is that the breadth of the entire market, including NASDAQ Composite, have actually been awful. And it's really been these Magnificent Seven stocks that have kept the indices higher just because they're such huge behemoths from a market cap perspective that they're holding everything higher. And really, I mean, outside right now, only Google and Meta are stocks that are actually pressing highs and holding this trend in place. And so we're seeing more and more of the generals being shot. I mean, the way that we see obviously Tesla weak here, but also you take a look at the way that NVIDIA has rolled over is that a head and shoulders pattern, topping formation that's developing there. If we see the earnings in any way start cracking the Magnificent Seven, that really could be a driver that causes index selling in a broader way. And so that's why I think next week is going to be so critical. And so I agree with you on your assessment there quite a bit. Touching, though, on page 6, we have the volatility index, and we're still in the teens. I would think that at this stage, with the way that things are, the volatility premiums on market insurance would have been heightened already, at least into the mid-20s. Now, at this stage, with us trading down here, I still think you can go long volatility, even though there's always the vulnerability of us returning back to the summer lows. But like realistically here in mid-October, where volatility reigns, the idea that we're going to see the VIX on a 13 handle again just doesn't seem like a probable call. Anyway, how do you view the VIX here?
So right now with the VIX at around 19 change, we can expect to see about 1.25% broad market moves per day. And right now, what I'm looking at is a possible break above 20 and a hold above 20, which would then precipitate a possible pop to 25 to 30. Now, that would probably require some exogenous event to pop it that high. But right now, if you're watching the intraday ranges on SPX, for instance, we're seeing a lot of whipsaw action where we push in one direction for maybe half the day, and in the last couple of hours, we revert back to the mean again. So, these moves aren't outlandish, like the 1.25% moves. We're not seeing a lot of those moves each day in terms of like the finishing price from the opening price, but what we're seeing is a lot of whipsaw action intraday. So it's kind of hard to read the price action overall using the VIX because, again, predicated upon the average 30-day expiration on SPX. And right now we have over 50% of the option trading volume is on 0 DTE. So a lot more weight is put on the 0 DTE options. So following that kind of flow is more important. And what I'm seeing is that if we stay in this little range right now between 18 and 20, it's more probable we're going to see a pop higher, and that could probably be spurred on by perhaps some premium selling on the put side, where we get below a certain floor level, like 4,200, for example, and then we just keep rolling down because so many people are underwater on their short puts. Now, moving on to page 7, we have the US dollar index. What are your thoughts here?
The Dixie peaked out at 107, and it's now consolidating in a range between 105 and 107. So the question obviously becomes, okay, is this consolidation that's occurring between 105 and 107 a continuation pattern that's, winding up for maybe another move higher? Or is it a reversal pattern that's maybe setting up for a move to the downside? Well, it seems to me that probably the reason we're consolidating here is the market's waiting for some kind of indication as to whether there's going to be further geopolitical escalation. And if there is, it seems to me that a continuation of further dollar strength in the face of increasing global geopolitical tension makes perfect sense. So I'm bracing myself for a move higher on the dollar, but I think it's going to take a geopolitical catalyst in order to bring that move about.
Eric, while you're identifying that trade range, I actually think that there's a really good chance that the U.S. dollar is going to continue higher, and that in itself would be bearish for most risk assets. When you look here, the dollar has been consolidating in that range you're highlighting, but that 107 level is going to be critical because any breakout of the dollar above 107 it could set in motion a dollar upside acceleration, and when you really break break it down on the individual majors and how they're all trading, the Euro USD, incredibly weak chart. The pound against the US dollar, incredibly weak chart. The US dollar yen trading up along the 150 level like it's ready to break out. You look at the US dollar against the renminbi, up along its highs, ready to break out. The US dollar against the CAD, up along its highs, ready to break out. There is literally no chart that is diverging from this, and there doesn't seem to be a catalyst that is imminent that it could change this dollar trend. On balance, I actually think there's a good chance here the dollar's about to rip, and that could end up being a very big contributor to broader weakness in risk assets. So this is, I think, a critical chart to watch. It's one of the things I think is going to dictate a lot of the other trends as we move forward.
And moving on to page 8, we have the gold futures chart. Eric, what are your thoughts here?
Well, the chart looks terrific, and in many ways, it feels like this market wants to discount the idea that rates have already peaked and nothing can go wrong for gold. I'm not so sure about rates peaking or nothing can go wrong, but unfortunately, I do think the geopolitical tension that's helping to put a bid under gold is likely to continue. So, to my thinking, there is a setup here that maybe this is the beginning of the really big move up for gold, but we would need some confirmation that we really have reached a peak in interest rates, and I'm not at all convinced that that's true. So I think that we're probably going to see further strength in gold. At some point, I think there's going to be a hiccup when we realize that maybe the last round is not in yet for higher interest rates as the Fed continues to fight inflation.
You know, Eric, I look at what happened in the last week on gold to be actually a game changer. I mean, we've been in a 6-month consolidation in gold, and it's been one thing that we just had to say, well, listen, this simply isn't the time when gold is ready to go. But you have a scenario where the US dollar remains very strong, a typical period where gold should be under pressure, and yet geopolitics has created this extraordinary reversal, bringing us right back to the summer highs on gold. And to me, at this stage, this is the first bullish price action we've seen since that November to March rally at the end of last year, going into the first quarter of this year. And if we see gold able to hold above 1900 on a sustained basis and above its 200-day moving average moving forward, we'll ask a very important question as to whether gold is diverging from its natural intermarket relationship and trends, and actually geopolitics driving a new accumulation cycle. It is very early or premature to already get super bullish gold, but this is the most bullish price action that we have seen on bullion in a half a year, and so I'm paying attention. I think it's going to be really interesting to see whether this develops into something bigger. I wanted to, on page 9, though, talk about the US government bond on the 10-year yield. And we have just seen an outright acceleration in yields rising, and this it's not even like the bond sell-off is actually losing momentum. And this, to me, is another big red flag. Typically, for the last 30 years, bonds have acted as a safe haven asset during periods where equities are under pressure, and yet we have the exact opposite, where actually the bond bear market is now actually grabbing the equity markets by the ankles and dragging them down. And the big question here is are we about to see a crack of 5%? Because that could be one of these things that drives a little bit of a shock wave through the markets, and that could be what spurs some volatility in everything next week. I think watching the yields here is critical. The final thing I wanted to touch on page 10 is the Uranium Trust. This is the Sprott Physical Trust, and uranium's been in a multi-week consolidation after an extraordinary breakout, but this is one of the few places that remains in a very clean bull trend. And after this kind of a consolidation, the big question here is, are we about to see another bull breakout in uranium? It's a very bullish chart, and I'll be watching, at least on this Sprott Physical as it's priced on the TSX, a breakout above above $23 to see whether or not it is spurring on a new advance. We obviously have the U308 already trading back above 70, so it'll be interesting to see whether uranium starts a new bull trend.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.